Ladies and gentlemen, big breaking news. The CPF Board will be launching a new investment scheme. Prime Minister Lawrence Wong just announced that in a budget 2026, and this could potentially bring us higher returns over a long period of time. And every CPF member must take interest in this. And today I will share with you what some of these highlights are. I will take some benchmark from another country that looks probably similar. And what does this mean for all of us? So CPF launches the new investment scheme, and the key takeaway is that we may potentially face higher returns moving forward. Prime Minister Lawrence Wong announced this scheme in Budget 2026 with a lot of other things that could get Singaporeans excited. But more importantly, I'll just narrow down on this one scheme. The new CPF investment scheme basically takes across a broad-based investing, probably global diversified products, okay, and manage them with different assets, and they have quite some interesting feature. I think this is a very good for people who like to have hands-off investing. Now, this is where I would capture what we call a glide path. So what it probably means is that, for younger CPF members, they could potentially invest and enjoy higher equity ratios and lower bond ratios. And as their age increases, they should have now more equal balance towards bonds and equities, especially around 45, 50 years old or so. As they approaches near retirement age, you will skew towards more bonds and less equity. And this is basic investment 101. I'm glad that CPF is now structuring a scheme that geared towards this kind of glide path. I think it's also important to mention that this kind of glide path will be automatically done. Okay, and some robo-advisors probably have something similar structured, but I think to have it structured at a national level by CPF Board, I think that will be very good for investors that basically one hands-off investment. Now, interestingly, there is a phased liquidation strategy somewhere before we reach retirement age. Okay, there will be a gradual portfolio liquidation, and this sum of money will eventually go to your retirement account if you haven't meet your full retirement sum, and the excesses will go to your ordinary account. Now, for those people who don't know, you can then transfer ordinary account, okay, voluntarily to your retirement account to push it up to enhance retirement sum, which I strongly encourage everybody to do so. Okay, and as you hit 65, 70 years old, your CPF Life will start paying you out generous lifetime payout, which I think everybody should be excited about. So this is what we call a phased approach. What I really like about this scheme is most of it is auto, all done for you, right? You hands off, government arrange everything for you. Isn't that very nice? Now, they will go down to 2 to 3 reputable providers. Now, actually, the CPF-IS scheme today have, I don't know, 50, 100 providers. I don't know, just too many. I can't complete looking at the whole list. But what these 2 to 3 reputable providers would do is that they have to go through a rigorous evaluation phase. My guess is almost like a tender kind of thing, and they will be competing against each other on the ease of structure and possibly the cost to make sure it's as low as possible to make things as simple for all CPF members who are investing in this new scheme. The key feature of this, on top of the simplified hands-off method of investing, is that the fees will be kept low. Now, a lot of people don't appreciate how important fees is, but there are a lot of fees out there in the market, especially things like investment-linked policies. A lot of them charge 1.5 to 1.7%. That will eat up a hell of your investment returns, and many of them end up losing money to our investors. But this scheme aimed to push the fees really low. I guess it's because you got volume, economies of scale and volume, and make it as transparent as possible. So if we can push it really down, and that will mean that the power compounding will yield higher returns, And I think that's very important. Now, to be frank, these are early days. The CPF board need about 2 more years to launch it. So by March 2026, industry consultation will begin, and you'll gather feedback from stakeholders. And somewhere around 2027 first half, they will select the fund providers, and then give them a few more months or so, they will launch it in the market, right? So they are looking at first half of 2028 to launch, and I thought that's the timeline they are given. I wish they could do it a bit faster, but I guess that this kind of thing affects many CPF members, so maybe good things cannot rush. The question is, who is this suitable for? Is it suitable for you? Now, this is suitable largely for CPF members that have a time horizon of 20 years and above. Why 20 years? Well, there's a investment philosophy that investment return for a globally diversified portfolio will you only positive return for investors, okay, with a high level of probability if you have a long time horizon, generally 15 to 20 years. And then this is a timeline they're all looking at. So if you are 20, 30, maybe even borderline 40 years old, I think this would be great for you. But if you're like me, 50s, okay, or 60s or 70s, I think maybe this one, the time horizon may not be suitable for you, okay? And you must be prepared with some kind of market volatility and prefer, like me, passive investing, automation, hands off, let the system take over, that kind of thing. And of course, you are seeking growth beyond just CPF returns, okay? And I think this is also for people would have low investment knowledge, okay, but want better return, okay? Is clearly not suitable for people who know it all. They know how to invest really. Then there's no need for you to let someone take over the process if you are so kiang already and so good. Is also probably not suitable for people with senior high in their seniority in age, and of course not suitable for people who completely cannot take volatility. Even a bit of volatility, you can't sleep. You see your savings go up and down, you can't sleep. Then don't touch, right? So in short, it is at the middle end of the spectrum. At the low end of the spectrum are people who cannot take volatility, don't touch. At the high end of the spectrum are sophisticated investors. You know what to do. You're already yielding better returns. You already know how to execute investments. You know what to do. Don't touch. But quite a big chunk of people, want better return, can take some volatility, don't really know how to do it. Trust this system for 20 years, it should give you quite good return. Now, this is where I want to draw a parallel with Hong Kong. This is because a lot of details are not available yet for the CPF new investment scheme. So I'm going to draw a parallel from the Hong Kong MPF system, and they do have a similar system called the core accumulating fund. Okay, and by understanding a core accumulating fund of Hong Kong, you probably have a flavor what possibly could be that of the Singapore system. So the Hong Kong core accumulating fund has launched since 2017, and is part of their default system. It uses globally diversified portfolio, right? A lot of people start to appreciate how powerful globally diversified portfolios are, and it auto enrolls non-chooser. That means it is a default plan. It is a opt-out plan, okay, and it has got powerful regulation around it, okay, and it has proven quite good results since 2017. So in terms of the asset allocation for people who are below 65 years old, generally it puts into about 60% equities and 40% bonds, okay, and let it just accumulate and compound. As it grows past 65 years old or so, and then it goes largely into 80% bonds and 20% equities. So in the case of Singapore, past a certain retirement age, which undefined right now, you will go into a retirement sum. Okay, retirement sum, and the surplus above the full retirement sum will go to the ordinary account. So this part is slightly different, but it's okay. Not that it's any superior or inferior. Now they have a automatic de-risking process, which is somewhat like our glide path that the CPF talking about. So when you are young, you can have 100% allocation to the core accumulating fund, okay, which is basically what our system is gearing towards. And gradually, as you go to 65 years old, you will start changing the composition towards eventually more bonds and less equity. So the key thing is, this is very similar to the Singapore structure that is coming. When you're young, more equities, less bonds. When you're old, more bonds, less equities. So this is okay, or rather younger Singaporeans with at least a 20-year time horizon, and it'll be perfect for investors who like the passive approach with low investment knowledge but wish to take on higher returns. And I would say again that people who cannot tahan volatility, okay, and people are already sophisticated, you know what to do already, then this is not for you. So let me know whether you have let me know whether you have any comments, okay? And tonight we will be doing a live stream with Dollars and Cents. Tim from Dollars and Cents will be hosting the event, going on the 1865 YouTube channel and also the Dollars and Cents YouTube channel to do this live stream from 9:30 onwards. Please join us as we answer all your questions on budget 2026. Okay. Thank you, and I hope that this is interesting breaking news for everybody. We look forward to more details coming out during the later part of the budget discussion called the COS, where the minister will announce more detail. Okay, this is breaking news for you. Thank you, and signing off. I'll see you tonight. Remember, hit subscribe and like to our channel. Okay, have a great evening.